Okay, good afternoon, everybody. Welcome to the fourth Ohio Landlord Association webinar. This is the presentation for today will be delaying distress in Ohio, how foreclosures, forbearance, and moratoriums are impacting the Ohio real estate market. We have Daren Blomquist with us today. If you're familiar with him, he's national expert on the real estate market. So we're going to be hearing from him in just a minute. Josh is not available today, so I'll be taking over. My name is Chris Hofford. I was the vice president of Freeland Lending and been working with Josh for 5 years. So we'll be working the presentation today. Just a little bit about the agenda. Give you a little overview of Freeland, Freeland properties, Freeland companies. I'll introduce you to Daren Blomquist, and then he'll take the presentation over from there. You can see here he's going to be touching on a few things about foreclosure backlog, the delays due to COVID and the short-term impacts of those delays, investor opportunities, longer-term impacts and opportunities. So those are that's a 10,000-foot overview. Be closing with some questions. Of course, you can type them in at any time, and we'll get to them at the very end. Daren will be happy to answer any questions you have. Try to keep it moving. It's Friday. We've got about an hour, so we'll try to get through this as fast as we can, so we leave as much time as we can for questions or just in general conversation. If you haven't seen any of some of our other webinars, those are on demand at freelandventures.com/OLA. Jack Petrick put on a presentation about multifamily property management. Tyler Brummett, who works with Freeland, how to scale your apartment portfolio. Last guests we have were Gary Cooper and Anthony DeMarco. Keeping a pulse on your property, key steps in maximizing value and performance. So those are all available to you on the Freeland Ventures website, freelandventures.com. If you want to go listen to those when you have a minute. As far as Freeland companies, right now we're operating 3 independent companies. Freeland Capital Management, which is a company that manages our funds, manages investor equity and cash, ARV assets, just in general. It's a money management arm of our company that operates on behalf of our investors. Freeland Properties, this is our newest and our most centric operation right now. We're purchasing assets, multifamily apartment buildings, multifamily 1 to 4 unit residential units. If you can see by the slide here, we're 75,000 right up to 25 million A and B class area properties, 9% cap rates. This is the kind of thing that our investors want to invest in, we want to invest in, and so we're pretty heavy into that right now in the Northeast, well, actually the Ohio market in general. We'll be acquiring properties throughout the state of Ohio moving forward. Freeland Servicing, obviously, you know, we are a lender. Loans need service, so we have a servicing company that operates on behalf of our investors, and they also assist with property management. So that's a quick view of the Freeland companies as it stands right now. This particular presentation is sponsored by David Streeter. He's been a live event speaker for us at Freeland. He's been speaking at a number of Freeland live events. He's a very experienced real estate investor here or lawyer here in Cleveland. He does a lot of work for the principals, Josh Cantwell, Glenn Lytle, He does work for us personally in our own investments and for the company. Fantastic individual, answers his phone, very nice guy. He just opened a new brokerage, Streeter and Petropolis. So definitely get his contact information, write that down. And if you're in the northeastern Ohio area or you want some representation in Ohio, he's definitely an individual that will, we think does a great job for us, and we think he'd do a great job for you. So Dave Streeter Jr., give him a call the next time you think you might need some legal services. The speaker today, Daren Blomquist. And if you've listened to Josh's podcast, if you have been to live events, I mean, Daren, he's been a speaker for at Freeland live events for a number of years. He knows he's virtually an expert in the national real estate market. Okay, he's the vice president of market economics at auction.com right now. I mean, he forecasts complex macro and micro data trends within the marketplace. I mean, he's just all over what's going on in the national real estate market. He's been a live speaker for Freeland before. He's a very interesting guy, knows exactly what's going on in the market today, able to, talk about what's going to happen, what they think is going to happen, what has happened, just all of the things you need to know just to make some decisions for your business. I mean, he's been published and appeared on many national broadcasts, and you can see here CBS, ABC, Fox Business, CNBC, Bloomberg. He's been published in the Wall Street Journal, New York Times, USA Today. So definitely consulted by many people when they want information at a high level and know that it's accurate. So we'll, with no further ado, we'll just turn it over to Daren and bring him in.
Great, thanks so much, Chris. It's very good to be here and talking to you virtually. Hopefully at some point, not too distant future, I'll be able to be back at the live events. So I always enjoy those, and getting feedback from investors who are on the front lines of the market. And yeah, I'll jump into the data here pretty quickly, but just a quick background on auction.com and myself, in addition to what Chris already said. Yeah, we look at auction.com sells distressed properties on our platform. I'm sure many of you are familiar with their platform. And in 2019, we sold about 60,000 properties. It's probably going to be a lot fewer this year because of the foreclosure moratorium, but we'll be talking about that in a second. But I get to look at the rich transactional data we have in terms of both our buyers and our sellers, for the banks selling these properties, and the behavior that both buyers and sellers are engaging in when they're bidding on properties, and just looking at trends. So I'll be talking a little bit about those trends, as well as trends I look at in public record data, more of the macroeconomic, or at least macro housing trends, with a focus on Ohio. But certainly it's been an interesting year, to say the least. And yeah, so the focus for me in this will be the kind of the juxtaposition of short-term versus long-term from the perspective of investors. What are the short-term impacts of all that's going on right now? And then what will be the more longer-term impacts? And so, yeah, with that, we can jump into the first chart there, Chris. And by the way, yeah, please feel free to submit questions. And they've given me the access to see the questions here. So certainly, if you have questions as I'm talking, I will try to keep an eye on that and address those. And if not, certainly at the end, address any questions that come in. So the foreclosure backlog. And I mean, I think the implicit piece here in this headline is that there is a foreclosure backlog, and I think it's pretty self-evident that there is. But if it's not, here's just some data from our platform showing the number of properties brought to foreclosure auction. And I didn't mention auction.com sells basically two types of properties. Primarily, one are properties that are selling at the foreclosure auction, which is also called the sheriff's sale in Ohio. These are properties that have gone through the foreclosure process and are basically that is the final step in the foreclosure process. And then the second type of property that we auction off, and I'll get into this later too, are the bank-owned properties, those that have already been foreclosed. And those are all online. The second part, you can go, I've actually been talking to quite a few investors in buying in Ohio recently for some reason, but you can go online and find those properties. And there's no moratorium on those already foreclosed properties selling. So we're doing pretty brisk business there. But on the foreclosure side, properties, because of the moratoria on foreclosures that I'm sure most of you are aware of, and that's that Fannie, Freddie, and HUD have all implemented a foreclosure moratorium. And the exemption is vacant or abandoned properties, which we think is very smart. So that's actually why you see here, the red line is 2020 properties brought to these foreclosure auctions on the auction.com platform versus the gray line in 2019. First few, through about week 13, the foreclosure auctions in 2020 were keeping pace pretty much with 2019, staying on that same heartbeat, but then we flatlined. And now the numbers have started to come back a little bit, but we're still, and this is nationally, in the first 8 weeks after the pandemic, actually not quite the first 8 weeks, but the 8 weeks ending July 4th, we were still at 5% of the 2019 level. So only 5% of foreclosure auctions that were happening in 2019 were happening in 2020. We started to tick up a little bit in the 8 weeks ending August 29th. We were at 14%. And so those are primarily vacant or pretty much exclusively vacant or abandoned properties that are now going to foreclosure auction. And the lenders are getting more comfortable with, yes, we can foreclose on these. And actually, there's some data that I think I'm going to get to later that will show that it's actually a really good idea to let investors take on these vacant or abandoned properties, because otherwise they cause neighborhood blight. So we are starting to see those tick up, but still at 14% of the 2019 level. So there is this backlog building up. The next slide shows this happening in Ohio. Somewhat similar trends. Ohio is actually ticking up a little bit faster than the nation. We're talking about smaller numbers, so there's more volatility in these week-to-week trends, and this is by week, by the way. So, but we are at 16% of the 2019 level in Ohio in the 8 weeks ending in August 29th. So a little bit higher than the nation, coming up a little bit more. And then the next slide is a heat map showing these 8 week increments by state across the nation. And so Ohio is at 7% of last year's numbers in the 8 weeks ending July 4th. And by the way, I'm happy to make this presentation available to anyone who's interested. So you can go in and click on the interactive heat map and get a little bit more detail on each state. But then just doing some, I guess, basically back of the napkin math to figure out, okay, how big is this foreclosure backlog? We're obviously delaying a lot of foreclosures that were happening in a good economy. We're not talking even about foreclosures that are the result of this crisis, but kind of business as usual foreclosures from those previous two charts. we're creating this big backlog. So let's try to quantify that a little bit. We're estimating using our data and public record data, prior to the pandemic, COVID-19 pandemic hitting, there are about 4,200 properties a week brought to foreclosure auction. That may sound like a lot, and that's even in a great economy. Now, so about a third of those sell to investors, about 2/3 of those go back to the bank, typically at the foreclosure auction. That ends up being, so anyway, now fast forward, we're at 345 a week now nationwide, which is just crazy, that delta in the number. And so using some assumptions that basically the delta between 4,200 and 3,500, we're assuming only 45%, or excuse me, 55% of those would be going to foreclosure right now if there was no moratorium, because of the forbearance programs that allows borrowers to go into forbearance and delay payments for up to a year. Black Knight has the numbers that indicate about 45% of people who were delinquent before the pandemic are taking advantage of those forbearance numbers. So there's 55% that are not going into forbearance. And so using those assumptions, we're estimating a backlog of about 2,100 a week that would have been going to foreclosure auction that are not, that are just being delayed. They're not going into forbearance. So that ends up being a backlog of 88,000 properties nationwide if the moratorium is lifted at the end of the year. Right now it goes to the end of the year. So 88,000 properties not hitting foreclosure sale that otherwise would have. And again, this is just looking through the lens of kind of regular foreclosure activity that's not the result of the this economic crisis that we're in. And then the next slide shows that, goes through that same exercise in Ohio. And then this heat map here is showing the 8-week period ending in August 29th. So you see there, first I'll start with the heat map. The orange states are states that have come back a little bit quicker, and we're seeing foreclosure auctions ramp up a little bit faster. Even, Oklahoma is the top of the list there. We're at 54% of last year's levels now in Oklahoma, but still that's the highest of any state. Most states are much lower than that. You see even New York is at 0% still. But Ohio is kind of in the middle of the pack there, 16% relative to a year ago, as I mentioned earlier. But I do want to make the quick point that despite the moratorium, foreclosure auctions are happening. And so that's, and I'll get into this a little bit later, but that's one of the short-term opportunities for investors is there is some inventory out there of foreclosures, and it's actually inventory that's often very appealing to investors because it is very heavily skewed toward vacant or abandoned property. So you're not dealing with evictions and that sort of thing. You are buying a property that's vacant or abandoned and able to start work on that right away. There's no delay. But anyway, in Ohio, just doing the same kind of numbers of the backlog, we're coming up with a backlog of about, by the end of the year, of about 6,000 properties that once, basically what this means is once the foreclosure moratoria are lifted, those 6,000 will have to come back into the foreclosure pipeline and be auctioned off. And so what we've seen in previous situations is that you'll see an uptick in foreclosure auctions pretty soon after the foreclosure moratoria are lifted because of that backlog that is building. So yeah, Chris, you can go ahead to the next one here. And so that's the, I guess I'll call it business as usual backlog of foreclosures that were already, mortgages that were already in trouble outside of the current crisis that we're in. But behind that backlog is another backlog of delinquent loans. And so when we look at that, this is some data from Black Knight looking at 90-day delinquencies. And what we're seeing is there's 2.25 million loans that are at least 90 days delinquent nationwide. But they haven't started foreclosure because of this. The foreclosure moratorium also is a moratorium on foreclosure start, so they're not even entering the process. That's up 454% in the last 4 months. It's increased by 1.8 million. And Black Knight does not, at least publicly available, have the state-by-state numbers, but just doing a very rough estimate, this would suggest about 158,000, 157,000 in Ohio specifically. The thing that really stands out to me here is that this ratio of 90-day delinquencies to foreclosure inventory is 12-1. Historically, that's the red line there. Historically, you can see that's been about 2-1. Actually a little bit below 2-1, and now it's skyrocketed to 12-1, meaning there is a big backlog of these delinquencies that haven't even hit foreclosure. And this politicians and mortgage servicers, I think, are rightly not repeating the mistakes of 2008 when the recession actually was preceded a little bit by this huge wave of foreclosures that hit the market and blindsided the market. And so these moratorium forbearance programs are designed to prevent that, but you still have the distress. The distress is not as obvious. It's not hitting the market right now, but it is still there underneath the surface in these delinquencies. And these will have to be dealt with down the road. Many of these delinquencies are in forbearance because they've happened after the pandemic started. Speaking of forbearance, the next slide gets into that. We have now 3.9 million loans in active forbearance. Yeah, Chris, you can advance to the next slide there. And I have the numbers for Ohio, their estimates. And so these are loans. Now, there's an overlap between the previous slide and this one. There's some properties that are delinquent in forbearance, but there are also some that are in forbearance that are not delinquent, and some that are delinquent that are not in forbearance. So it's not a complete one-to-one, which is why you see this 3.9 million here. And the thing that stands out here, there's 3.9 million actively in forbearance right now. Over the lifetime of these forbearance programs, which began back in April, we've seen about 6 million homeowners enter forbearance overall. Some of them obviously have exited forbearance. The thing that stands out to me is we're seeing the overall forbearance numbers going down, which is a good sign that people are getting out of these programs. But what we're seeing is the FHA and VA forbearances are up, continue to be up. And this was as of last week, and I think the numbers that came out earlier this week continue to show those going up. And we see that's going to be a theme here in my presentation, is that FHA loans are going to be the hardest hit during this crisis as a result of this crisis. And we see that in a quote from the MBA chief economist, who the MBA is one of the sources of these forbearance numbers. But we're seeing this disproportionate impact on FHA and VA borrowers because of the lower down payments and higher debt to income ratios that were happening on those loans going into even before this crisis. And the next slide shows, so where are people in forbearance who have left the forbearance program going? The good news is that 70% of them so far who have exited forbearance have either paid off their loan or reinstated the loan, become current. And so that's a really good sign. The more troubling pieces of this in terms of, and I guess more potential distressed inventory down the road, is in the 22% of borrowers who have entered some kind of loan modification plan. And then even what's puzzling actually to many industry folks is that 6.3% of borrowers who've exited forbearance, even though they can keep extending the forbearance with virtually no documentation for up to 12 months, there's still been so far over 6% of these borrowers who have left forbearance and there's no loan modification, no loss mitigation for their loans. They're just basically going back into the default pipeline. So they, in addition to the foreclosures we talked about earlier, these are people who have become delinquent post-pandemic and have gone into forbearance and then are just going back into the foreclosure pipeline. And that ends up, if that 6.3% holds true for the entire pie of 6 million forbearance borrowers, that's going to end up being about 378,000 folks who just go back into that foreclosure pipeline. And then additionally, you have the 1.3 million who are at risk still, because that's the 22% who are going into some kind of loan modification. But what we've seen with, the loan modification performance in the wake of the Great Recession was you ended up with, within several years, it ended up being almost 50% of those folks did end up still delinquent and eventually entering foreclosure. So hopefully this is answering those questions about the backlog. I mean, we have, just to summarize real quick, just the pre-pandemic backlog that's being built up ends up about being 88,000 by the end of this year, 88,000 properties. And then on top of that, you do have this seriously delinquent backlog of about 1.8 million that are 90 days plus and are going to be high risk for going into foreclosure after the moratoria are lifted. Now, we'll get into now kind of the next topic, which is, and I'll try to go through some of this stuff faster because I'm spending a lot of time, but short-term impact is this moratorium are actually cutting off a huge source of supply. And now it particularly impacts investors. Investors are buying distressed properties, and so it particularly impacts this audience. But it's actually a pretty big source of supply. My thesis here is that foreclosures are somewhat comparable to new home sales in that these are properties that were not really available to the retail market for sometimes years before the foreclosure happens. And then once an investor buys it and rehabs it, it actually then is becoming available to the retail market, similar in some ways to a new home. So if you compare new homes and foreclosures over the years, we see that historically foreclosures are about a third of that supply of those two sources of new retail supply combined. And so you're cutting with this moratorium, you're in effect cutting off a pretty big supply in the housing market of and what that's doing to the housing market on the next slide is it's making the housing market look really good. There's a classic V-shaped recovery, and you're probably seeing out there in the news. And existing home sales have just bounced back after a couple months down, and they were up by 25% in July, biggest increase ever in the history of the NAR report. Home prices are at a new all-time high, both nominally and adjusted for inflation. And home prices are accelerating. So there's this frenzy, almost frenzied feeling around the housing market right now. And I think there's some other things going on that we probably don't have time to get into, but you've probably heard about that are helping to build up this frenzy. But one of the big elements of it is the fact that we're cutting off a huge source of supply to the housing market, which is foreclosures that are then rehabbed and put back on the retail market. So that's some of the short-term impacts and why you're seeing some of that. But I would say there's some, and most of the investors I have talked to have a healthy skepticism of some of these gaudy numbers that we're seeing, and I think that's a good thing. It's not that there's some good fundamentals beneath these gaudy numbers, but they are being exaggerated by this somewhat artificial holding back of supply. The next slide shows specifically the distressed market. When we look at our platform, we're seeing some of the same metrics. There's more competition for a smaller pool of properties. So a lot of the foreclosures are cut off. So the main source of inventory right now on our platform, and for many investors, are properties that have already been foreclosed, the REO properties. And we're seeing the average bids per asset and the average price per square foot trend higher. There was a little bit of a downturn you can see in March and April, but it's picked back up. The percent of these with competing bidders has bounced back as well for the most part. And then the price execution, which is the winning bid on these properties relative to what the bank is, the minimum amount the bank is looking to get, the reserve amount, is going up, and it's at a new year-to-date high in August of 103.5%. So there's more competition for distressed properties in the market. We're seeing that, and that's certainly going to squeeze potential returns for investors. The next slide shows that specifically the vacant properties that I mentioned earlier, we're seeing even higher numbers on what we call our demand metrics for those properties, because that's in part because I think of the eviction moratorium. So investors have always been more interested in vacant properties, but that has accelerated post-pandemic, where we're seeing more competition even for those vacant properties. You don't have to worry about the eviction piece. And then Ohio, I just pulled some of the numbers for Ohio there as well. It's a similar trend. You know, we're seeing more competition, although it is slightly below the national average in terms of bids per asset. And certainly one of the things that stands out about Ohio, if you go to the next slide there, Chris, is the average price per square foot for these online REO auctions is significantly lower. It's less than half of the national average. So, you know, it's a double-edged sword. There is more competition, but especially in Ohio, there are some really good deals available. You know, if you just compare it to the national average in terms of price per square foot that you're paying for these properties. And the next slide puts this in context. So, well, actually, before we get to that, just keep in mind here and one of the things too is vacant properties, even though there's more competition for them, the price per square foot is lower, both nationally and in Ohio. So there is good opportunity with these vacant properties, even though there's more competition. Now, the reason for that is, I would say twofold, is the vacant properties tend to have more deferred maintenance, and so they may not be in as good condition, but also there's the unknown with these properties. And so a lot of times you may not be able to get into them to view them beforehand. And so the investor is taking on some risk, but often getting a much better price point because of that. So just keep in mind this $38 per square foot for Ohio properties that are selling. And then the next slide will show that on a national level. Nationally, we're seeing even the REO properties are selling about $81 a square foot. So Ohio's numbers are significantly below that, which is, I think, part of the reason that Ohio has become an attractive place for investors to come and buy. But the other point of this slide is that in general, even though there's a smaller pool of distress and there's more competition, distressed properties, both the REO properties and the foreclosure auctions that are happening still, and this is basically year-to-date numbers, post-COVID, still getting a significant discount off of retail with these properties. So there are the opportunities in the shorter term because of this artificial pulling back of supply are less, but still there for investors. And then the next slide is a heat map showing this through the perspective of properties bought on our platform if they were rented back out at the average fair market rent in their areas. What kind of returns would you be seeing? And the returns, the blue is the returns that are not as good. The darker the green, the better the potential rental returns. And you do see, and this is again year to date, so this includes post-COVID, there's still opportunities, there's still, and especially in, you see a lot of those dark circles around Ohio and the Rust Belt in general, and the Midwest. That's where the opportunities are for some of the best returns on specifically rentals. We've looked at this through the perspective of fix and flip as well, and it's a similar map because of the price points that can be achieved on these properties in the Midwest and the Rust Belt. And then I did want to touch on the next slide on something I mentioned earlier, just on this idea of the vacant properties. And we are starting to see, this is data from Adam Data Solutions. We are starting to see the percentage of vacant foreclosures go up after they have been trending down for quite some time. But in the third quarter of this year, we saw that increase, and it's up to the highest level in 3 years. And so it's still not a huge number. It's still well below the peak that we saw back in 2014 after the Great Recession. But many metros are starting to see the increase in the percentage of foreclosures that are vacant, which makes sense because these properties, because of the foreclosure moratoria, these properties are sitting longer in foreclosure, and that gives more opportunity for these properties to become vacant or abandoned. Now, the good news for investors is that as we see more of those, the lenders, because there is an exemption on the foreclosure moratoria for vacant or abandoned, we should see more of those come to the foreclosure sale going forward. And we are making the argument to our sellers, the lenders, that you don't want to be responsible for a bunch of vacant properties in neighborhoods that are contributing to blight. And so it is better to foreclose on those. It's better for everybody. There's no homeowner losing their home at that point. They're losing their place of residence at least. And it's helping the neighborhoods. So is the short version of it. Someone asked here, I don't know how long ago this was asked, I apologize, I just noticed this. How can we have info for each state? And so on some of the heat maps I've shown, they are interactive heat maps that you can float over and see the information for each state. And so I'm happy to make the presentation available, and maybe Chris and others can let you all know how that will be made available. But in the presentation itself, you'll be able to click on the link and go there and see the data. For instance, on this heat map, you'll be able to float over. This is by metro area, not by state. You'll be able to see the details for each metro area. Great. So moving on to, there's opportunities with these vacant properties that we think that have been recently increasing, and that should show up at the foreclosure sale in the near future. Something you may have heard about is this everybody's fleeing the cities and going rural, right? And there is data to support that. It's probably overstated in some of the headlines, but basically this slide is showing that we're seeing stronger price appreciation in smaller mid-sized cities, rural fringe areas, mid-sized suburbs. That's where we are seeing the strongest home price appreciation based on public record data. And we see that in our own platform as well. Investors are going more to the suburb, buying more in the suburbs and the rural areas. But this, and I think that's an opportunity. There's opportunities on both sides of this coin. You follow the population to as an investor to where they're going to, which is right now tends to be more suburbs or even rural areas. You see the large cities there have only less than a 1% appreciation in the second quarter of 2020 is what this data is for. So that's a little trickier. Now the other side of the coin is there may be some great opportunities to buy in some of the more urban areas because people are fleeing those in the short term. And that could be a more of a long-term opportunity. This trend that we're seeing it is something of a continuation of a trend we were already seeing before the pandemic. And that's the next slide just shows that some census data showing net migration. People were not leaving all cities, but people were leaving places like California, coastal California, and New York. And even in 2019, this is data from the census. Illinois is the other big one. But most of the reasons at that point, I believe, were because of high property prices and high property taxes and other taxes that were high. And so you see people leaving those areas. People, Ohio still has negative net migration, although it's nowhere near the level of a place like New York or California. People are tending to flee to the Sun Belt, Texas, Florida, Arizona, Southeast. Even the Northwest, though, is interestingly picking up some population. So I think what we're seeing with the pandemic is somewhat of an acceleration of this trend and somewhat of an altering of this trend. But this is an opportunity more for the long term for investors, is to keep an eye on these demographics and to be going where the people are going. Following the population. The next slide is a little bit of a shift in this, and I'll be wrapping up here in just a couple years. When we see what we saw in the last housing crisis in New Jersey, which was really the main state that instituted a very extensive foreclosure moratorium like we're seeing now, we did see a prolonging of the pain, and the foreclosures peaked nationwide actually in Ohio, they peaked in 2013. They didn't peak in New Jersey until several years later, and 4 years later in 2017. And we believe a lot of that is due to the foreclosure moratorium. And so the short story here is that in states, in the aftermath of this crisis, in states that tend to kick the can down the road, you're going to see a longer tail of distress, like in New Jersey, forming. And so that's something to keep an eye on, is how the market you're investing in is approaching this crisis. We've created what we call a long-term forecast of how we believe this crisis is going to play out, and that's on the next slide. The short version here is that this is the number of properties coming to foreclosure auction, and to the left there, that shows historically what actually happened. The blue line to the right shows what we believe is going to happen. We're at this artificially low level. We're going to gradually ramp up, and finally, because of all these delays, we're not going to actually peak until 2024 in this crisis in terms of the foreclosures. But we're still going to be 39% below Great Recession levels. It's going to be a shorter, we believe, a shorter lived crisis in terms of the foreclosure volume. So over the entire period of the elevated foreclosures, we're going to be at about 50% of Great Recession volume. But still, certainly, there is going to be an event where we see in the longer term opportunities with distressed properties for investors. Specifically, I did want to hone in on the next slide with FHA. I mentioned that earlier. We do believe we saw this even before the pandemic. If you go back and look at some of the stuff we were writing about, is we were expecting FHA to be a problem in this market, and that is proven to be true with this crisis. The FHA delinquencies are at an all-time high. Other delinquencies are not at an all-time high, but this crisis has particularly impacted FHA borrowers from several reasons. And so places with higher density of FHA loans are going to be affected. The next couple slides just beat on that point about FHA, why the why behind why those loans are so susceptible to a crisis. Basically, these borrowers don't have as much equity. And then the next slide shows these borrowers are have lower credit scores. And so they're just at higher risk in general. And this crisis is going to tip a higher percentage of those into delinquency and foreclosure, unfortunately. And from our own data, the next slide just shows that this is already happening. We're already seeing, now again, we're talking about small volumes here, going back to what I talked about at the very beginning, but we are starting to see clients with HUD loans. HUD is the same as FHA. We're seeing those numbers pop back up faster and more extremely than we are, for instance, Fannie and Freddie. That's basically what this slide is saying is and this is looking at what we call foreclosure inflow on our platform. So banks basically giving us inventory that they expect to be bringing to foreclosure auction in the next 6 months. So this is a little bit forward looking. And then the final slide here looks at those numbers by state, so you can compare. Ohio has seen a big increase. This is comparing the 2 months ending in August to the previous 2 months. And again, this is foreclosure inflow. So this historically about 50% of properties that go into foreclosure inflow end up at foreclosure auction within the next 6 months. Just be cautious, the 193% increase in Ohio, it's coming off of an extremely low number because of the foreclosure moratorium. But the point is we're seeing that inventory start to pick back up. And so there are opportunities and now, and we believe in the next 6 months as indicated by this data. So there you go. And yeah, there are several questions about the presentation, which I've already addressed, but if there's any other questions, that's all I got.
All right. Well, Daren, do you think there's any chance that states work in tandem with the lenders to expedite the foreclosure, or at least not expedite the foreclosure process, but keep it moving quicker so that homes aren't sitting, in a backlog?
Yeah, I think one of the things that we're seeing with this crisis is that policymakers and lenders seem to have learned from the last crisis to a certain extent, not completely. I do think that's a lesson. One of the lessons they learned is that the unintended consequence of just delaying foreclosure on everything across the board was that you ended up with this so-called zombie foreclosure problem. And so we are hearing, and then policymakers rush to address that. And so we are hearing from a lot of folks on the neighborhood stabilization side that we talk to, that they are pushing to, particularly on the vacant or abandoned properties, to push those through and expedite the foreclosure sale on those. So yes, I think there is a good chance of that, and we're already seeing some of the momentum build on that side of things.
Yeah. Are these homes that you talk about in your presentation, do you delineate between owner occupied and investor properties?
No, we don't. That's a good question. No, we don't. And that is something I'm curious about. I'm not sure why you're asking the question, but certainly that there is a theory that the investor-owned properties may be more susceptible because investors in general are not as protected by a lot of the policies that have been enacted. Right.
And then, okay, all right, great. It would be interesting to know if what the percentage of foreclosures are due to people not paying their rent and investors not being able to continue to make those payments.
Yeah, I may be able to get back to you on that. I'm cross-referencing some of our, we don't have it inherently in our data, but cross-referencing some of our data with public record data that may be able to provide that information down the road, hopefully soon.
Would you say, do any owner occupied buyers use auction.com?
Very, very few. I mean, we've done some surveys. That's less than, the breakdown is, yeah, the vast majority are investors. About 60% are fixing and flipping, and about roughly 33%, about a third are buying and holding as rentals. The remainder is kind of in that other category, and I would say of that other 5 or 6%, there's maybe 1 or 2% that are actually buying to occupy. The reason for, there's several reasons for that, but as you can probably imagine, but a big reason is these are just not retail properties for the most part. These are properties that need an investor to come in and do what they do best, fix up the property and make it clean it up and for retail. Yeah,
because you can't even get in to see them, I don't think, right? Most of them?
That's right. Yeah, that's another big reason. It's not a traditional sale. A lot of times you may be able to do a drive-by, and we provide as much information as we can. There's quite a bit there, but that's a big stumbling block for many owner-occupied buyers.
Yeah. Would you say that, are there any other questions that you have to answer that are in the chat box?
Just, on the presentation, it looks like, I'm assuming you guys, there's a question about how they get that. So, I'm sure you guys can let the audience know how the presentation can be distributed.
Yeah. Do you have, what percentage of homes that are foreclosed are auctioned off versus rehabbed by the bank and tried to be put back into a more retail condition and sold to? I guess I'm trying to figure out on these foreclosures, what percentage of a foreclosure goes back on the retail market so that owner occupants can buy them, relative to virtually all of the inventory falling into investors' hands?
Yeah, that is actually a great question that that we look at quite a bit. So I'll start at the beginning of the funnel is properties going to the foreclosure auction. About 1/3 of those go directly to investor buyers at the auction. Of those. Now that's nationwide. On our platform, a higher percentage, it's more like 40%, and actually in recent months, because of lower inventory, it's been 50%. But anyway, 1/3 they go to the auction nationwide, go to investors, and then the other 2/3 of the other 2/3 that go back to the bank, we would say it's probably going to be about 75% or more go the retail route, where the banks try to fix them up and put them back on the retail market themselves. Now, what we've tried to show with data to the banks is that local investors are actually better at doing that than they are. And so better to just sell them via, of course, there's some self-interest in this for ourselves as well, but to sell them via our platform to investors rather than try to do the rehab themselves. And we have some strong data, and one of the big sellers that's been convinced of that is HUD. Their own numbers show that they get a better outcomes financially if they sell via what's called their REO alternative program, which is basically selling on a platform like ours.
Right.
And so they are pushing more inventory that way because of that. Anyway, that's where it stands right now. And one of the things is even when the banks put these back on the retail market, many of them end up selling to investors anyway.
Right.
So yeah.
And you know, because you couldn't really fix up too many and put them on the market in a retail environment without driving prices down because supply increases, you know? So you kind of have to, do the banks have to parcel those out in increments so that they don't, you know, create a situation like, you know, in the last recession, it seemed like the banks had to hold a lot of inventory for quite a while rather than, you know, put it all on the market at once.
Right. Yeah. And there's some theories behind that, but right now we're in a market environment where that seems to be starved for inventory. So we're not arguing, it's probably the wrong word, but we're letting the banks know, hey, now is a good time to sell because there's a lot of interest. So if you have, and some are giving us extra inventory that they've kind of been holding off on for whatever reason.
Yeah.
So yeah, I mean, I think if we got into an environment where where the foreclosure volume starts to ramp up quite a bit, you would probably see some more careful attention to releasing that inventory because they don't want to shoot themselves in the foot.
Right. Do you think that you could sell, do you think that there's not unlimited demand by investors right now, but pretty close to unlimited demand for investors to purchase properties at auction?
Yeah, I mean, that's good. Right now, I mean, we've been somewhat surprised by the strength of the demand. And so, yeah, right now I wouldn't say unlimited for sure, but I think there's caution. The investors I've talked to, they see a short-term opportunity to buy, but they're cautious. They're actually padding padding is maybe the wrong word, but they're creating more margin in their numbers to make sure, just in case there is a downturn, that they have a cushion to provide for that. But there's still, this market is still providing plenty of cushion for many of those buyers.
Right. Okay. Well, we appreciate you taking the time to jump on with everybody today and you know, give us some insight.
And yeah, I would just say, if we're posting a lot of this stuff, and by the way, it was Natalie had let everybody know that this presentation will be sent out via email to everybody next week. A lot of this stuff in this presentation, and actually a lot more, we're posting on our newsroom, which is auction.com/in-the-news. If you want to go look at this and other information we're posting. I have a great video from a couple buyers who are buying in Ohio, actually, using our platform from last week. And then in addition, I just, you know, auction, as a shameless plug, you know, please go to auction.com and check out the inventory that's available. There's, we are getting new inventory from banks, and so it's out there. Check it out. It's free to go in and search and register, and you can see what's available.
Okay. Now, do you have any newsletters or anything that you send out yourself that people can subscribe to?
We don't. The best source of that is the newsroom, which I mentioned, which is auction.com/in-the-news, all one word, in the news. We are posting regularly on there a lot of this type of information.
All right. Okay, great. Well, we appreciate you coming in, and thanks for everything. Well, I'm sure we'll hear from you again. We'll have you in again, right?
Sounds good. Yeah.
Okay. All right. Take care. All right. Thanks, everybody, for joining. Hope everybody got something that was useful in that presentation that they can use and take with them in implementing their business, or at least help them make decisions about their business. And we'll see everybody again at the next one, or at least we'll hear everybody at the next one. Hopefully we'll see everybody, but if not, we'll see you online. Thank you.